Back in 1990, the cost of a gallon of regular gas was around $1.15. The cost of a dozen eggs was $1. The cost of a gallon of milk was $2.78. And the average cost of a new home was right around $150,000. Compare these prices to what you see in your hometown today, and the difference is pretty staggering. Most people have parents or grandparents who reminisce about the past when everything was so comparatively cheap, but the reality is that prices go up over time no matter what, at least in an economy that's healthy. Inflation is the reason for that, and while some amount of inflation is good, the one thing that we should be concerned about is if the rate of inflation gets too high. So lately, with inflation at its highest reported number since 1990, reaching 6.2% in a single month year over year, the mainstream media, Americans, and other countries are keeping an eye on inflation and what's to come. So today we're going to teach you everything you need to know about inflation and how it's going to affect you, and we're going to start with what inflation actually is. Inflation is the decline of purchasing power for the same amount of money that you have. So a simple example is that if milk usually goes for $2 and now it suddenly costs $5, you now need more dollars to afford the same thing. Your purchasing power just went down, and there are a few different types of inflation that actually cause this. One of the easiest to understand is demand pull inflation. This is a fancy term, but all it really means is that there's more people trying to buy the same amount of products. A simple analogy here is the used car market. There's not many cars available right now, but the demand for them is high. As such, the prices of used cars have been going up and being inflated due to the mismatch of supply and demand. Economists will describe this effect as, quote, too many dollars chasing too few of goods. The second type of inflation is known as cost push inflation, and this is when there's an increase in production costs such as raw materials and wages, and that's passed on to the consumer, aka you. A simple example here is that if you're a factory producing headphones and all of a sudden there's an unexpected increase in the prices of your components or an increase in taxes, well, you're going to pass those costs along to the consumer, resulting in higher retail prices, and that's cost push inflation. Another type of inflation is the increase in money supply. If there's all of a sudden more money in the economy chasing the same number of goods, then surely prices will increase. We saw a huge influx in the money supply these past 2 years, with $5.5 trillion being added to the M2 money supply, but as I'll explain later, an increase in money supply is not always a direct cause of higher inflation. So now that we know the types of inflation, how does one measure it? Because if we're able to quantify inflation, perhaps we can make efforts to mitigate it. When people go and measure the rate of inflation, the most common way they do that is with a metric called CPI, which stands for the Consumer Price Index. The CPI was introduced as a way to measure the price of a basket of goods from one time period to another. Imagine you go to Costco today, or your favorite supermarket, mine is just Costco, and you buy a few things every single month, for example, milk, eggs, toilet paper, some Pellegrino sparkling water if you're feeling fancy, some fruit, clothes, and whatever. The point is that you buy the same basket every single month, and that basket ends up costing you $100 at the end of your shopping trip. A year later, you're on your usual weekly shopping trip to Costco. You say hi to your favorite sample man, Richard, but after you go and check out, you look at your receipt and you go, my basket of goods costs $105 now. So what happened? The basket of goods has stayed the exact same, but now you're actually paying $5 more or 5% more for that same basket of goods compared to last year. And that's how inflation is calculated with CPI. The Bureau of Labor Statistics does this on a regular basis. They measure the increase of how much that basket costs, they report that number every single month, and they compare it to periods in the past. Now, if you're super curious, you can actually go to the FAQ section on the Bureau of Labor Statistics website on CPI specifically, and you'll find that there are a lot of government securities, such as the tips and Social Security payments that are linked to it. If you Google, does CPI impact Social Security, you'll find that by statute, the SSA uses the CPI to calculate the annual increase in benefit levels for Social Security and SSI payments. Also within the Bureau of Labor Statistics website is where you can find a lot of handy charts to see exactly what sectors or parts of that basket are rising the most on a year-over-year basis, or on a seasonally adjusted basis. Just as an example, if we go into the charts section of the latest report, we'll see that the biggest percentage gain in any category is energy. And if we click on Show Table, we can actually see that gasoline is up 49.6% year over year from last October. Okay, so inflation has been trending up recently, but what's actually causing inflation? How is it stealing our money, and what can we do to defend against it? Let's talk about causes first. The causes of inflation usually stems from the instability of the world and of the economy itself. Any imbalance of equilibrium in the labor market or price stability might inspire policies that would then cause inflation to go up. Because we have a labor shortage, the government might enact financial policies, for example, that might cause inflationary pressures. Similarly, let's take an example of what's going on in the world right now with the supply chain. The US imports a lot of goods from overseas. Let's say we're importing tapioca, and as these goods come in on shipping containers, they get funneled into our ports, offloaded onto the dock, picked up by the trucks, and then delivered to their final destination. But because of the pandemic, not only are there delays in the production of goods overseas, there's a labor shortage on our side at both the docks and truck drivers, causing a bottleneck in how quickly goods are being offloaded at the port and to their final destination. This labor shortage is causing a decrease in the supply to their end destination, resulting in higher prices to the consumer. Another cause of inflation right now is the excessive demand that we're seeing. With the onset of the pandemic and national lockdowns, one of the threats to the economy was that people were just staying inside and not spending any money. The government wanted to encourage demand and have people keep spending money, so they sent out stimulus checks, and the point of those were to stimulate the economy by having people spend it. Now, chances are, if you get some money and it's free money from the government, you're likely going to spend it in your local economy, and that's exactly what the government was going for. So in terms of inflation lately, we're seeing both cost-push inflation with labor shortages and production shortages, as well as demand pull inflation where there's excessive consumer demand for goods. And this should be true for any future cases of inflation as well. If there is inflation, it probably has to do with these two types of inflation. When it comes to the money supply, when we do put more dollars into the economy from stimulus checks and small business grants and whatnot, it technically should result in more inflationary pressures, but just because there's more money in the supply doesn't automatically mean there's more inflation. What really matters is where that increase in money supply goes. There's a metric that we can look at called the velocity of money, which refers to the frequency at which money changes hands. When you look at the graph of velocity of the money supply, we can see that it's actually headed downward since Q1 of 2020. This is basically telling us that the money supply might not be directly contributing toward purchasing goods and products. Rather, people are using the increase in money supply and going out and buying assets like real estate and stocks, which means that their money is tied up and not actually contributing toward the velocity of money. So my life pretty much follows that exact pattern. I find myself investing a lot of my spare dollars into the stock market, and chances are if you receive stimulus checks, you've probably invested some of your money into the market as well. So what should the inflation rate be? At the beginning of this video, I said that inflation was 6.2%, but the actual rate, according to the Fed, should be closer to 2% annualized. That's their target. This is the rate that's needed for two things: maximum employment and price stability in the economy. But why is it a positive number? Why isn't it 0%? Wouldn't 0% be the ideal number for inflation? Well, in doing some digging, there are three main reasons why the Fed wants a positive inflation rate number. The first is measurement bias. So let's actually listen to David Wheelock, a member of the St. Louis Fed, and what he had to say about it in a podcast in 2017.
So when the observed rate of inflation is, say, 1 or 2%, that's really the true measure is actually probably lower than that, closer to 0. So just simply measurement bias would be one reason to target a positive rate.
The second reason for positive inflation is that you want to avoid deflation. Now, deflation is the opposite of inflation, when the same amount of money you have today can buy more things tomorrow. While that might sound like a good thing, a deflationary environment incentivizes you to delay your purchases. And by doing so, your lower spending will actually result in lower income for producers, which can then lead to unemployment and harmful effects in the economy. In general, deflation is really bad, and the cost of a negative 2% inflation rate would be higher than the cost of a 2% positive inflation rate. Now, the last reason you would want a positive inflation rate is the following. Let's listen to what David has to say again.
A higher level of interest rates gives the Fed a little more room to cut in the event of a recession. So it's a bit of a cushion that allows monetary policy to operate a little more through its traditional interest rate channel.
And that totally makes sense. Cutting interest rates kickstarts lending and the economy. So in periods of tough economic times, that's one weapon that the Fed has to nudge the economy in the right direction. So you might be wondering, well, inflation has been going up this entire year. Why hasn't the Fed increased interest rates in proportion? Currently, interest rates sit at 0.25%, but if they raise rates, they would be able to nudge inflation downward, right? I found that it's quite a delicate situation. The Fed's goal is to maintain price stability and the labor market. But because the labor market is not yet fixed and stable, for example, we have people not working due to wage mismatches or they can't find a job due to the pandemic, the Fed is really focused on spurring that activity for now. If they were to raise interest rates, that could actually have reverberating effects on the labor market and send the job market into a severe decline. The labor market is way more important to the US economy than price stability is, and the Fed knows this, so it wants to right the labor market ship first and foremost. Now, that's not to say the Fed isn't aware of the inflationary situation that we're in, and that's why they've begun to set expectations for tapering, which means that they're going to be buying back assets at a slower rate, and this could be perceived by the market as a more hawkish stance on inflation. So how will inflation eventually come down? The Fed doesn't actually have that many tools at their arsenal to combat inflation. They can put policies in place like tapering to nudge expectations of inflation lower, but that's all they can essentially do. They can nudge. So for example, with tapering, if they pull back on buying assets, they're hoping that this sends shockwaves through the banking system, which will hopefully then tell consumers it's going to be much harder to get a loan, so you better not spend as much money, which should in turn lower demand for goods. What I found in the past week has been more of an interesting psychological phenomenon, which is that inflation follows expectations. Because so many people are freaking out about inflation being here, it creates a feedback loop of panic. When people think that higher prices are here, businesses will freak out because they want to price in those expected price increases, and then workers and their unions want similar size raises as well. The Fed has said that they'll taper by the end of this month and also continue stating that inflation is transitory, trying to temper expectations. The reduction in bond purchases will conclude around July 2022, and we could see some interest rate increases in the coming year. All right, so how is inflation stealing your money and what can you do about it? Simply put, if you put $10,000 in a savings account and it earns 0.5% APY, which would actually be quite high for now, at the end of 1 year, you will have $10,050. But in the meantime, if inflation is at a much higher rate, say 5%, the same goods you could have purchased last year would cost you $10,500. That would result in a net loss of purchasing power of around $450. If the inflation rate is higher than the rate that you can get a return on, then inflation is stealing your money and your purchasing power slowly but surely. So what do? My friend Kyla Scanlon actually put out a great video on inflation and shared a research paper with me about some of the best strategies that you can employ during inflationary times. You should definitely check out her channel and subscribe to her and tell her I sent you because her content is phenomenal. Now, in the paper, it states that one of the strategies to hedge against inflation is to buy assets in the correct sectors. While stocks do get hurt by inflation, some stocks do tremendously well. They actually found that, quote, traded commodities have historically performed best during high and rising inflation. So, things like copper, gold, silver, iron, and oil. Another sector that does well is energy, so you could look into investments like ETFs that focus on the energy sector. For example, ticker symbol XLE is a prime example of that. The paper also interestingly points out that collectibles do well during periods of high inflation. They found that collectibles, the real annual returns, are positive during inflationary periods for all three asset groups. Art was plus 7%, wine came at plus 5%, and stamps at plus 9%. When it came to cryptocurrencies, the paper actually looked at Bitcoin and noted that Bitcoin is an unreliable hedge because it's 5 times more volatile than the S&P 500 and gold. And that, quote, the correlation of US equity and Bitcoin returns suggest that Bitcoin may not deliver positive real returns in periods of unexpected inflation. While Bitcoin should theoretically have no correlation to the overall market and inflation, the reality is actually quite different. People move their money in and out of Bitcoin and into other assets like US treasuries and in times of economic uncertainty, such as back in March of 2020, in which this was the case. Then, when things weren't looking as grim, money flowed back into Bitcoin, which suggests that actually Bitcoin is speculative and correlated somewhat with the US market. Lastly, with real estate, while it is a good thing to lock in a lower interest rate right now, not many people have a ton of money to do that. If you're able to get some real estate, the research paper does find that it holds its value during inflationary times, which is a good sign. So in summary of today's video, inflation is everywhere, prices will always go up over time, and expectations of inflation are actually what matter. This is everything that I've pretty much learned about inflation in the past week. I thank you for watching. Make sure to subscribe, and I'll see you guys in the next video. Peace.